Alright, today we're going to talk about country risk analysis, chapter 16. So what I'd like to do is to go ahead and talk to you about some specific areas. We're going to talk about common factors. So I'd like to kind of highlight the fact that we're going to talk about factors that multinational corporations use to measure country risk analysis. I'm going to talk about techniques that are used to measure this country risk analysis, and then the overall measurement of how the multinational corporations tend to measure this risk. We'll talk about different types of assessment, and we'll talk about how host governments, how to avoid multinational corporations to get taken over by government as they are in a foreign market. Why is it important for multinational corporations to know how to measure risk? Couple of areas that are important for them to determine that. Number one, they want to be sure that they will continue to do business in a particular market. Another risk or another area of interest for them is to be able to determine if they should implement new products or get into new markets for subsidiaries. So those are critical for them to be able to measure that risk. All right. So let's kind of go a little bit more about how do they go about measuring and what is the importance of this country risk analysis. For multinational corporations, there are several areas of importance. They want to be sure that they can measure the impact of cash flows under the environment they're in. They want to be able to monitor countries where these multinational corporations are currently doing business. Additionally, multinational corporations want to be sure that they can revise investments and decisions as they are into specific markets or going into specific markets for some reasons, such as terrorist attack that they might be going into. A couple of examples that I can say is what happened a few months back with France that impacted companies that were already in that particular market. There have been several terror attacks in Spain and some other European markets as well, and that does impact how that cash flows and making decisions of whether they have to postpone production, whether they have to not be able to do extensive business due to the fact that there's a lot of security within that area. A couple other areas that are important as well is major labor strikes that the company can have in a particular industry. And those things do happen. That has happened in some of the South American countries, has happened even here in the US. Political crisis due to scandal. A couple examples that I can mention when it comes to scandal is the one that we had many years back with our own president, and there was a scandal that created a lot of distress for companies dealing with a particular scandal here in the US and impacted all around the world. Concerns about a country banking system, and one of those countries that I can mention would be probably China. And then imposition of trade restrictions on imports. Having been an importer, there are some markets that eventually restrict imports because that eventually creates a lot of competition within local markets. Moving forward, we look into factors, and so let's talk about political risk. And when we talk about political risk, we can look at different areas that are going to impact multinational corporations from a risk perspective. A lot of countries, as multinational corporations are going to these particular markets, the key here is the attitude for consumers in the host country. So by that I'm saying a lot of local consumers are more interested in buying products that are made in their own market. So if you see anything that is made in the US, the government or the consumers might tend to be more loyal and might not eventually want to buy specific products from the US. And so that might restrict about how much revenue and cash flows that the multinational corporation will be receiving due to loyalty. So that's one thing that has to be considered. Another area is the action of the host government. And by that I mean situations where the government might make some restrictions. They might eventually have impose some pollution control standards, might change specific copyright laws, might have some new enforcements and change policies. And so that could create a little bit of stress for the multinational corporation having to make some changes and put more cash flow into those different types of enforce different standards. A couple areas that are critical for multinational corporations is the blockage of fund transfers, where they might not be able to really either take money out to pay back loans that are back in the headquarters. Another example could be they might not be able to take back those funds to be able to buy more supplies. And so that is a restriction of not being able to do much with those funds. We talked about currency and convertibility. You might not be able to change the currency back into whether it's dollars, and you might have to decide to leave that currency within that country. And then we talk about war, and this is something that is very unpredictable. And when it comes to war, it might not just be the country that you're in, but it might be neighboring countries that they're working with. So they might have, for example, working in India and having some restrictions with some country conflicts with war, whether it's Pakistan in some cases, or if you're dealing with, in the case of Russia, or anything that can really impact the company in this case of unrest or political risk. Then we have inefficient bureaucracy, and this is what we talked earlier, and we talked in chapter 13, that has to be with specific areas of maybe corruption, which will be the next one that we have, but more to do with the fact that political officials might be asking for specific gifts. Employees might not do any projects unless they get specific gifts, specific rewards to get the job done. In order to get an application completed, they might eventually request for that bureaucracy. Corruption. Corruption is a key one, and it's one that can really impact a multinational corporation as they do go from market to market. Multinational corporations might eventually look into what's critical, the corruption index, and kind of monitor that in a regular basis. So if we go to the next slide, this was, if I'm not incorrect, maybe about a few years back, maybe from 2013, 2011. And so these index ratings are going to impact how multinational corporations are going to enter a particular foreign market. So let's look at Switzerland, is 9.1. The ones that are on the top are the ones that are less corrupt. So if you were going to ask New Zealand, Finland, Denmark, Singapore, the ones that are less corrupt, most countries would tend to want to do business in that type of country because the corruption is fairly less. But if you go to the other side, look where the US is located now. The US is actually 7.3. The last time I checked with the corruption index, we were about 19, so we had gotten a little bit more with corruption. But if you go all the way, look at India, China, Mexico, Russia, some of these countries we're currently working on, and we're actually getting into those countries, Brazil, China, India, Mexico. And those want to be a little bit much more corrupt than the other ones, such as Finland and Denmark. But we're still doing business there. The companies just have to be aware that in those markets that we do business with, there's going to be the possibility of a much higher risk due to the corruption index. Moving forward, if we go back into looking into political country risk factors such as financial risks, then we have here different factors to consider. We're looking into interest rates, exchange rates, and inflation, something that we have gone through our semester and discussed very in detail about how that's going to impact a multinational corporation. So when it comes to risk in general, one of the things that we need to keep in mind when it comes to interest rates, that higher that interest rate, that tends to slow down growth and reduce demand for multinational corporations' products. What we want to keep in mind is the fact that whether there's a recession, whatever the economy is going through, is really going to impact tremendously how quickly that economy will grow. And interest rates will impact quite heavily multinational corporations and will be one of the highest risks for them. Exchange rates. How quickly would the exchange rates change? A strong currency, as we discussed in previous chapters, may reduce the demand for the country's exports and therefore increase the volume of imports with a reduction of production and national income. And so this is a key market, or a key factor for them to consider how exchange rates will impact depending on what country you're dealing with. Inflation, we'll discuss inflation as well. Inflation can affect consumers' purchasing power and the demand for multinational goods. So these three factors are critical, and then once the multinational corporation is making an assessment, where should we enter, they need to keep in mind how much of a financial risk are they dealing with, depending on the market, the industry, and in general through these three particular factors. How do they go about measuring this particular risk? So we talk about political risk, we talk about financial risk, and we have specific factors between those two. But now we have to figure out how do they go about assessing that. So there's a couple of different methods, so different ways of looking into the assessment. One of them is an overall risk assessment that we call micro assessment, and it's just the overall picture of where do they fall in from a general perspective. You look at those two different factors, and now multinational corporations want to look at as a direction, a series of fundamental ideal of a fundamental structure, a way for them to determine an overall assessment of risk, looking into political and economical. Micro has to do more with a risk that has to do with assessing a specific country, at the same time, and more of a type of business or industry. Those are the keywords there. So micro, give them an overall direction, and the micro, giving them more of an assessment between looking at the country itself and looking at the business or industry. Those are the two ways. And so let's talk about techniques. How do they go about using some of these assessments, analyzing the different factors, and what kind of techniques can be used? So multinational corporations eventually have different ways of using different techniques, either one in particular or combining all of them. So let's talk about the first one. The first one talks about checklist approach, and that is by taking a rating assessment depending on different types of factors. So we talk about economical and political, taking a checklist of specific ratings. And so one of the things is basically taking and judging by, depending on the industry, depending on the market, how do they go about checking specific information that can be even actually accessed via the internet on a particular list of ratings. Delphi technique is a collection of independent opinions, which is basically asking people with expertise to provide them with opinions about, how much of a risk is there by country, by factors, and by different industry, without truly putting this into a discussion, collecting the independent opinions without a group discussion, just collecting them, a survey. So we have ratings, we have a survey, and then we have another type of technique that has to do more quantitative analysis. And that technique has to do more with specific models such as regression analysis. So it's a little bit more financial, a little bit more using numbers and having a little bit more weight average on how do we go about assessing that particular risk. And so they're measuring maybe with, depending on different types of periods of time, different models, identifying specific characteristics, indicating the quantity of impact by a specific area. Then the next one might be the expectation of visits, and that is more when you really have to go directly to that country, you visit with government officials, you visit with business executives, you eventually ask questions and meet with consumers and clarify specific risks. This is a big one that many corporations, multinational corporations, feel that by being in that country, talking to the government, understanding the local executives, working directly with them, you might be able to get a better understanding how much risk there is by really talking to those people and people that are running the business or running the government. So multinational corporations have all these different techniques. Doesn't mean that one is better than the other. It all depends on the industry, it depends on the country. But if they want to be very precise that the risk can be high in one market, and instead of using one particular approach, they might want to use a combination of all of them. And so that means depending on where you are, where you're going, how much of a less risk do you want to take, you can combine all these different methods and techniques to get the best answer when it comes to risks. So moving ahead, there is a couple more things that I want to mention. So here has to do with measuring country risk. So like I mentioned earlier, there is a variation of methods to measure country risk. There's all kinds of different ways that multinational corporations can measure that. Comparing the risk ratings among countries, that can be done through the use of foreign investment risk matrix. And so there can be a much better way, a much more accurate way to utilize this type of matrix. There are also actual country risk ratings across countries, and I'll show you the map. If you look at your textbook, there is a map that can give you a better idea, direction of how every country can be measured from a risk perspective. So there is a ranking that can be looked at, more of an accurate ranking when it comes to country risk. this risk is actually determined by the credit risk. So if we go back to that map, here's the part that it kind of gives an idea of country risk ratings among countries. So if you were going to do business in a particular country, so let me see if I can do this. If I'm currently now, let's say that I am in Thailand, and the multinational corporation is thinking about going to another country such as Vietnam. We're already in Thailand, but we're thinking that we want to go to Vietnam. We start looking at the ratings, and we find out if the rating for Vietnam is very similar to the one in Thailand, we might consider possibly going also to, let me see if I can do this, other markets. Oops, I think I did it wrong. Let me go back. So we said we are currently, we're thinking about going to Vietnam. We are currently in Thailand. Is that wrong? That's all right. And I'm considering that I want to go, and I'm going to try to see if I can do this right. I'm considering going to maybe Singapore. Okay, I did that right. And all it is, if I'm currently already in Thailand, I'm considering Vietnam, and we know that those two have similar ratings because they're right next to each other. That might allow me to consider another country with a similar rating, such as Singapore. So when it comes to look into these ratings, it allows them to make a better decision on the ratings of where they fall, specifically in the region that they're in. So what it helps us to better understand is, let's look at some that are very similar in ratings. If we're rating one of them, it will allow us to kind of determine if we should go to some other markets. So this is just a little bit of a guidance. All right. Now, here's a very good formula and a good way of determining that overall country risk analysis for multinational corporations. So we discuss political risk, and so we went to those factors, and we discussed those are factors that is going to impact the multinational corporations. We give particular weights and ratings. We think that there is much more of a concern about bureaucracy when it comes to the political factors. And so we know that this could be an area of concern for a particular market. On the other hand, so we have weighted what's going to be the political factors. Let's look at the other financial factors would be another ones. Notice that for a particular market, we notice that when we look at the ratings or the percentage per weight, that the last one of industry growth is the one that might impact that particular country that we're thinking about going to. So industry growth is about 40%. The whole point here is that there is a much better way to understand political risk, factor risk, and be able to do some weight average to get a better understanding of what's going to be the stronger impact from an overall risk analysis by country. If we look at the political risk, we look at the financial risk, we notice that the political risk is in this case much higher than it would be for the financial risk rating. And that allows us to do a better analysis and the determination of an overall country risk rating. A couple of the things that I want to mention from this chapter, and that has to do with how does this risk incorporates or integrate to capital budgeting. Every risk is going to have to be adjusted for corporations. So in other words, you know there's risk in a particular market. But it's going to impact most likely your cash flows. It's going to impact most likely the expected estimated cash flows that you're going to be getting from that particular country or risk or country or subsidiary. In that particular one, when it comes to discounted rate, the lower the risk rating implies that the higher risk and the higher discount rate. That has to do with you're expecting to get a particular return, and the way how I can explain this, that discount rate of a proposed project is supposed to reflect the rate of return on that particular project. So you must adjust it when there's much higher risk. So the expectations have to be adjusted. Again, we talk about discounting rate on the return, and then the other one has to do cash flows. You must adjust your net present value for those cash flows, as we might be dealing with specific risks by markets, So you might come with you might decide that maybe you're expecting to have a 20% a 20% risk for a particular, let's say you're thinking about going to Russia, you might think there's going to be a 50% risk that you might not get the probability of your cash flows. So you might eventually tend to say, I am going to adjust it about 20% based on whichever country, and so that you make an adjustment at about 20% due to risk. And then the last one has to do with assessing the risk of existing projects. So you already have something there, you might need to adjust projects that are already currently on that market due to the fact that, like we discussed, things change with time, and you might have estimated an adjustment of, like I said earlier, 20%, but eventually that might change. So you might need to realize or might need to review and check again that particular risk on projects or subsidiaries already in that market. So basically existing ones needs to be adjusted, cash flows now has to be adjusted, and any discount rate needs to be adjusted due to the risk. One more thing that is very important, and we discussed this in a couple of other chapters, and that is the use of certain techniques to be able to reduce any kind of takeovers from governments. Use of short-term horizons, and what that means is when you go into a marketplace, you want to be sure that you do it from a short-term perspective. Final exit strategy. Don't invest and think that you can be there long-term in case you have a takeover. So if you lose, if they take over a particular subsidiary, the loss of that subsidiary is going to be pretty low because it's going to be from a short-term horizon. You're going to avoid takeover. You're going to avoid reducing loss. You're going to avoid a lot of things if you do it from a short-term perspective. Just test the markets. Rely on unique supplies and technology. If you have something that is very unique, and let me go back to the first one. I just thought of an example that I meant to mention. If you're going to be there short term, you want to be sure that you use equipment that is used. You want to be sure that you don't buy a new building. You want to be sure that you're doing things that if you do lose them, it's not a major loss. So use equipment or buildings and things like that, short-term ways of getting into a market and testing it. Number two has to do with relying on unique supplies or technology. And that is something that is so unique to what your company has that the government cannot take you over because they need you to continue to bring the technology to that market. And so it's something that is so unique that they still want you there, and they will avoid interrupting the business. The third one has to do with hire local labor. If you hire local labor, the likelihood of them taking over is very low, because if they take over, the local people are going to lose their jobs. So that's another technique to be able to reduce any takeovers from governments. Borrow local funds, like I mentioned, I think it was in chapter 13 and other chapters. You want to be sure that if you want your company to succeed and stay there in the long term, if you borrow from local government funds, if they take you over, you won't be able to pay them back. So it's a way for governments to realize that they have to keep you, they keep running the business because they have more money that is local and needs to be repaid. A couple other ones is the purchase insurance. And this one, I have to say, not everyone needs to buy insurance. It all depends on the high risk that the company feels that they might eventually have. The premium of buying insurance for multinational corporations depends on how high the risk is for that market. The higher the risk, or the higher the country in risk, the higher the premium. And then it all depends. If you are going to a specific market where there's not a lot of political stability and not a lot of economic, you might not eventually need that insurance. But it is, it all depends on the risk. And last is the use of project finance. And for that one, is how much do you really want to invest, corporations, on project finance, which allow the multinational corporations to be more stable and less probability for the government to take over. One thing that I wanted to mention on the purchase insurance, if you look at your books too, the U.S. government provides insurance through what we call the Overseas Private Investment Corporation. So this is something that is available for corporations to reduce the risk in order to be taken over by foreign markets. What I like to do is I would provide with specific examples and questions about what are some of the techniques I will give an example, and I'm going to ask you to determine and differentiate about techniques by giving you examples. So you have to differentiate, you have to know the definitions and how that works. I'm going to ask you to give me examples as I ask you about government takeovers. I might even ask you questions more to do with what is the difference between the two assessments. You know, one is overall and one's more from industry. And I might ask you to understand clearly how to differentiate between the interest rates, exchange rates, and inflation when it comes to the different types of factors for financial risks. And I think that will cover chapter 16, and hopefully this was helpful to all of you. Thank you. That's the end. I'll see you when I get back.